In March, the Deputy Governor of the Bank of Canada, Carolyn Rogers, declared a productivity emergency in Canada. Despite having one of the most educated and skilled workforces in the G7, Canada ranks second to last in terms of value produced per hour worked. What is the root of this crisis? Simply put, Canada is not attracting the private investment needed to give workers the right tools to keep pace with our peer countries. In 2018, private investment in Canada lagged behind such investment in the United States by nearly $10,000 per worker. It is in this context that the Trudeau government has decided to deliver a hard blow that threatens to slow productivity growth even more. In the recent federal budget, Finance Minister Chrystia Freeland announced the government's plan to raise the capital gains tax bill for Canadians. The government would have us believe that this tax change will only impact the very rich, but this is simply not true. This change is bad news for Canadian workers. First, Ottawa increases taxes on the very investment we need to keep up with the other G7 nations. This means less investment in the tools, equipment, machinery, and innovative processes that help us be more productive and thus better paid. And second, an increase in taxes will deter the venture capital we need to fund startups. Investment in a new business carries a hefty financial risk, and higher capital gains taxes reduce the potential reward without lowering the level of risk. If we continue down this path, we may not only lose out on new investment, but also see a mass exodus of domestic capital. We have the brains and we have the talent. But without sufficient investment, we're fighting a losing battle. We need a tax system that encourages investment, innovation, and growth. This change does the opposite. The government must reverse course in order to stave off worse economic outcomes for Canadians. For a better understanding of public finance issues, visit IEDM.org.